Silver $90 barrier broken. What happens now? The line has been crossed. For decades, this price level stood as an impenetrable ceiling. Now it's shattered. But here's what most investors don't realize. Every time a major commodity breaks through a psychological barrier like this, what follows isn't celebration. It's restructuring. Industrial supply chains, currency valuations, sovereign debt strategies, they all recalibrate. The question isn't whether silver reached $90. The question is what breaks next, and whether you're positioned for what's already in motion. Welcome to Currency Alert. Now, if you've made it this far, you clearly understand that financial markets don't reward the casual observer. They reward the prepared. Here's a simple request, one professional to another. If you value analysis that treats your time and intelligence with respect, if you want economic insights without the noise, then consider subscribing to this channel. Think of it this way. You've spent decades building your judgment. Don't let algorithm chaos dilute it. Subscribe. Stay informed. Stay ahead. And tell us, where are you watching this from today? New York, London, Singapore, Mumbai? Drop your location in the comments. Let's see how global this conversation really is. Now, let's talk about what just happened to silver and what happens next. On a seemingly ordinary trading day, something extraordinary happened in the global metals market. Silver, the metal that has served humanity for thousands of years as both currency and commodity, crossed a threshold that many analysts believed would hold for years to come. The $90 barrier, broken. This wasn't just another number on a screen. For institutional traders watching their monitors in New York, London, and Hong Kong, this moment represented something far more significant than a simple price increase. It marked a psychological shift, a recalibration of value in a world where traditional markers of wealth are being questioned. The interesting part? Most people missed it entirely. While mainstream financial media focused on stock market fluctuations and cryptocurrency headlines, a quiet revolution was unfolding in one of the oldest markets known to civilization. Silver had been testing this resistance level for months. Each attempt to break through had been met with heavy selling pressure. Large institutional players had placed their bets that $90 would hold. They were wrong. The breach didn't happen with dramatic fanfare. There was no single catalyst that observers could point to and say, that's what did it. Instead, it was the result of multiple forces converging simultaneously, like tectonic plates shifting beneath the surface before an earthquake becomes visible. Professional commodity traders understand something that casual observers often miss. Price barriers aren't just arbitrary numbers. They represent collective belief systems. When silver traded at $85, then $87, then $89, institutional money managers were making calculated decisions based on the assumption that 90 would hold. Hedging strategies were built around it. Risk models assumed it. Trading algorithms were programmed with it as a reference point. Then it broke. What makes this breach particularly significant is the context in which it occurred. This wasn't a speculative frenzy driven by retail enthusiasm. The buying pressure came from a different source entirely, one that suggests structural changes rather than temporary excitement. Consider the historical precedent. When gold broke through its $1,000 barrier years ago, analysts initially dismissed it as unsustainable. They pointed to charts and historical ranges, arguing that gravity would soon pull prices back down. Instead, the breach marked the beginning of a multi-year repricing cycle. The metal didn't just break through, it established a new trading range entirely. Silver's situation carries similar characteristics, but with additional complexity. Unlike gold, which primarily functions as a monetary metal and store of value, silver operates in two worlds simultaneously. It's both an investment asset and an industrial necessity. This dual nature creates unique dynamics that pure precious metals don't experience. The industrial side of silver's story adds urgency to this price movement. Manufacturing facilities across 3 continents rely on silver for production processes that cannot easily substitute alternative materials. Solar panel manufacturers, electronics producers, medical equipment companies, they all need silver, not as an option, as a requirement. When prices were trading comfortably below the $90 threshold, these industrial consumers had predictable procurement budgets. Their financial planning assumed a certain cost structure. Supply contracts were negotiated with specific price ranges in mind. Profit margins were calculated based on historical norms. That comfortable predictability just evaporated. Now these same companies face a strategic dilemma. Do they rush to secure supply at current prices, potentially locking in costs that might seem excessive if prices retreat? Or do they wait, hoping for a pullback, while risking even higher prices if the trend continues? This isn't a theoretical exercise. Real businesses with real supply chains are making these decisions right now, and their collective response will shape what happens next in this market. Meanwhile, another group was watching this breach with equal intensity: central banks and sovereign wealth funds. These institutions don't trade based on quarterly earnings or short-term momentum. They think in decades and generations. When they observe a major commodity breaking through long-standing resistance levels, they see something different than individual traders see. They see monetary signals. The breach happened, the barrier fell. The question that matters now isn't why it broke. It's what this break reveals about the larger forces reshaping global markets. And that question has implications far beyond silver itself. Beneath every price breakthrough lies a story that numbers alone cannot tell. Silver's ascent past $90 didn't begin in trading rooms or investment committees. It began years earlier in decisions made by people who never intended to move markets at all, engineers designing solar farms, policymakers drafting climate legislation, military strategists assessing supply chain vulnerabilities, factory managers in Shenzhen planning production schedules 5 years into the future. None of them were thinking about silver prices. They were solving problems, making products, building infrastructure. But their collective actions created something remarkable. Invisible pressure that built slowly, steadily, until the structure could no longer contain it. Consider what happened in the renewable energy sector over the past 36 months. Governments across 4 continents committed to aggressive solar energy targets. Not suggestions, mandates. The European Union announced plans requiring member states to generate specific percentages of electricity from solar sources by fixed deadlines. China expanded its solar capacity faster than any nation in history. India launched programs to electrify rural communities entirely through photovoltaic systems. Every single solar panel requires silver, not a small amount. Approximately 20 grams per panel for high-efficiency models. Multiply that by billions of panels needed to meet these mandates, and a mathematical reality emerges that cannot be negotiated away. The metal must come from somewhere. Here's where the story becomes more complex. Silver doesn't come from silver mines, not primarily anyway. Nearly 70% of global silver production arrives as a byproduct of mining other metals. Copper mines, lead mines, zinc operations. When companies dig for these primary metals, silver comes along as a secondary benefit. This creates a unique vulnerability that few outside the mining industry fully understand. When copper prices fall, mining companies reduce copper production. They're not thinking about silver markets, they're responding to copper economics. But their decision automatically restricts silver supply, regardless of silver demand. The two metals are physically linked in the ground, which means their supply chains are permanently intertwined. Over the past 18 months, several major copper mining operations faced unexpected challenges. Environmental regulations in Peru forced temporary closures. Labor disputes in Chile disrupted production schedules. Declining ore grades in Australia meant more energy and resources required to extract the same amount of metal. These weren't silver stories, they were copper stories, but silver supply contracted anyway. Meanwhile, in a completely separate corner of the global economy, another force was building pressure. Central banks were expanding their balance sheets at rates unprecedented outside wartime periods. They called it quantitative easing, monetary accommodation, emergency liquidity provision. The terminology varied, but the mathematical reality remained consistent. More currency units chasing relatively fixed quantities of tangible assets. Professional money managers understand this dynamic intimately. When a central bank creates new monetary units, those units must flow somewhere. Sometimes they inflate stock prices, sometimes real estate, sometimes commodities. The specific destination varies based on investor psychology and regulatory environments, but the underlying pressure remains constant, value-seeking form. Silver sits at the intersection of these forces in a way that few assets do. It's tangible. It's finite. It has industrial utility that creates non-discretionary demand. And it has a 5,000-year history as monetary metal, which means investors instinctively recognize it as a store of value when currency confidence weakens. This combination creates what market theorists call structural tension. Not speculation, not momentum, something deeper. The electric vehicle revolution added another layer entirely. Each electric car requires approximately 1 kilogram of silver in its electrical systems. Not because manufacturers want to use silver, because physics demands it. Silver conducts electricity better than any other metal. When you need maximum efficiency and minimum space, alternatives don't exist. Automotive manufacturers initially dismissed this as a minor cost factor. Silver represented perhaps 0.5% of total vehicle production costs. Manageable, predictable. Then production targets escalated. Governments mandated electric vehicle adoption timelines. Consumer demand exceeded projections. Suddenly, automotive companies found themselves competing with solar manufacturers, electronics producers, and investment buyers, all pursuing the same finite resource. No single participant in this system intended to create a supply crisis. Each was simply responding rationally to their specific circumstances. But complex systems don't care about individual intentions. They respond to aggregate forces, and those forces just push silver through a barrier that was supposed to hold. There's a moment in every market shift when abstractions become concrete. Silver crossing $90 wasn't just a headline for traders to debate over morning coffee. It was a trigger event, one that activated predetermined responses across dozens of industries simultaneously. Contracts with price adjustment clauses suddenly kicked in. Hedging positions that seemed conservative last month now looked dangerously exposed. Procurement officers who had delayed purchase orders found themselves explaining to boards of directors why they waited. The breach transformed theoretical risk into operational reality. In Phoenix, Arizona, a mid-sized solar installation company received notification from its primary supplier. The price per panel would increase by 11% effective immediately. Not negotiable. The supplier's own costs had jumped due to silver content, and those costs were being passed downstream. The company's CEO faced an uncomfortable choice: absorb the increase and watch profit margins evaporate, or pass it to customers and risk losing contracts to competitors who hadn't yet adjusted their pricing. He wasn't alone in this dilemma. Across the electronics manufacturing sector, similar conversations were happening in boardrooms from Seoul to Stuttgart. Companies that produced everything from smartphones to medical imaging equipment suddenly found their cost structures outdated. Financial models, built on historical silver price assumptions, were now generating incorrect projections. Quarterly guidance issued to shareholders weeks earlier was already obsolete. Markets hate uncertainty, but they hate repricing even more. What made this situation particularly challenging was the speed of adjustment required. When raw material costs change gradually, companies can adapt through incremental efficiency improvements or strategic inventory management. But when a key input crosses a psychological threshold and establishes a new trading range quickly, adaptation timelines compress dramatically. Mining companies faced the inverse problem. Their assets had just been revalued overnight. Silver reserves that accountants had valued at $80 per ounce were now worth significantly more. This wasn't just an accounting adjustment. It changed the economic viability of marginal projects. Deposits that weren't worth developing at $75 suddenly became attractive at $95. But mines don't appear instantly. Even fast-tracked projects require 2 to 4 years from decision to production, and major operations, 7 to 10 years minimum, which meant the supply response to this price signal wouldn't materialize until well into the next decade. The market was pricing in scarcity that couldn't be solved quickly. Options traders saw this dynamic playing out in real time through volatility metrics. Implied volatility for silver options spiked to levels typically associated with geopolitical crises or major currency events. This wasn't panic, it was recognition. Market participants were acknowledging that price discovery was entering a new phase, one where historical ranges no longer provided reliable guidance. Currency markets registered the shift through subtle but significant movements. The dollar index, which measures the U.S. currency against a basket of major trading partners, showed unusual weakness in the sessions following silver's breach. This correlation wasn't coincidental. When hard assets reprice upward rapidly, it often signals declining confidence in fiat currency stability. Traders call this the monetary canary. Silver and gold have functioned as alternative stores of value for so long that their price behavior often telegraphs broader currency concerns before those concerns become obvious in exchange rates themselves. Portfolio managers at pension funds and endowments were receiving calls from risk committees. Standard asset allocation models assume certain correlation patterns between stocks, bonds, and commodities. But when commodities break out of established ranges, those correlation assumptions can break down. A portfolio that appeared properly diversified last month might suddenly have unexpected concentration risk. The question these professionals faced wasn't whether to react. It was how quickly to react and in what direction. Some saw the breach as a signal to increase precious metals allocation immediately. Others viewed it as an overextension likely to reverse, creating selling opportunities. Both groups were making rational decisions based on their analysis and time horizons. But their opposing actions created the volatility that made the market even more unpredictable for everyone else. This is how price discovery works in real markets. Not through mathematical elegance, but through thousands of participants making imperfect decisions with incomplete information, each response creating ripple effects that others must then navigate. Silver crossed $90. Simple statement, complex consequences. And those consequences were still unfolding. Strategic positioning isn't about knowing the future, it's about preparing for multiple futures simultaneously. Silver's breach of the $90 threshold created something that serious investors recognize immediately: a decision point, not the comfortable kind where one option clearly dominates. The uncomfortable kind where reasonable people, looking at identical data, reach opposite conclusions, where both action and inaction carry significant risk. This is where amateurs panic and professionals earn their credibility. The first scenario gaining traction among commodity strategists involves sustained momentum towards significantly higher price levels. Proponents of this view point to fundamental supply constraints that cannot be resolved quickly. They note that industrial demand isn't discretionary. Manufacturers cannot simply decide to use less silver without redesigning products and retooling factories. They observe that investment demand is still relatively modest compared to historic peaks, suggesting substantial room for inflows if broader market participants recognize the supply-demand imbalance. Under this scenario, silver establishes a new trading range between $110 and $130 over the next 12 to 18 months, not as a spike, but as a structural repricing reflecting actual scarcity. Mining equities would outperform dramatically as their reserve values get reappraised. Companies with significant silver exposure would see their enterprise values increase by multiples, not percentages. But scenarios are not predictions. They're frameworks for preparation. The alternative view commands equal respect among seasoned market observers. These analysts acknowledge the supply constraints, but question whether current prices already reflect too much optimism. They point to historical instances where commodities broke through major resistance levels only to reverse sharply when speculative momentum exhausted itself. They note that industrial consumers will seek substitutes aggressively at these price levels, potentially reducing demand more than bulls anticipate. This perspective suggests consolidation between $80 and $100, with elevated volatility as the market searches for equilibrium. Under this scenario, the breach was real, but the follow-through remains uncertain. Patient capital waits for clearer confirmation before committing additional resources. Both views contain truth, both contain risk. For businesses with direct silver exposure, the strategic imperative is clear regardless of which scenario unfolds. Companies that consume silver industrially must reassess their procurement strategies immediately. The comfortable assumption that supply would always be available at predictable prices has been invalidated. Forward contracts, strategic inventory positions, and supplier diversification all become critical rather than optional. Some manufacturers are already exploring this path. A European automotive electronics firm recently secured a 3-year supply agreement at fixed prices, accepting current elevated costs in exchange for certainty. Their competitor chose differently, betting that prices would moderate and preferring flexibility over security. 12 months from now, one of these strategies will look brilliant and the other foolish. Today, both are defensible. Investment portfolios face similar complexity. Traditional allocation models suggest holding perhaps 3 to 5% in precious metals as a hedge against currency devaluation and systemic risk. But these models were built in environments where metals traded within established ranges. When silver moves from 70 to 90 in compressed timeframes, does the appropriate allocation change? Conservative investors might maintain existing positions while resisting the temptation to chase momentum. Aggressive investors might view the breach as confirmation of a longer-term thesis worth overweighting. Both approaches have historical support. Neither guarantees success. The monitoring framework matters more than the initial position. Serious market participants aren't making one-time decisions and walking away. They're establishing metrics to track whether their thesis is being validated or contradicted by subsequent developments. Key indicators include physical delivery requests from futures markets, central bank purchasing patterns, industrial inventory levels, and mining production data. When these variables move in alignment, confidence in directional views increases. When they diverge, reassessment becomes necessary. What makes silver's current situation particularly significant isn't the price level itself. It's what the price level reveals about broader economic architecture. Monetary systems built on unlimited currency creation eventually collide with finite physical resources. That collision creates repricing events that ripple far beyond the specific commodity involved. Silver crossed $90. That's the fact. What happens now depends on decisions being made in boardrooms, trading floors, and policy chambers across the global economy. Some of those decisions will prove prescient, others will prove costly. The only certainty is that ignoring this development entirely, that's not a strategy. That's a choice to let circumstances dictate outcomes rather than preparing for them. And in markets where information moves at digital speed while physical supply moves at geological pace, preparation isn't optional anymore. It's survival.